You just got your April P&L back from your bookkeeper. Revenue is up, net income looks solid. You're feeling pretty good about the year. I'm going to tell you something that might sting a little. Your P&L is probably lying to you, and in peak season, it lies the loudest. I'm Melissa with Summit CFOs, and today I want to show you why your profit and loss statement looks the best right when it's the least trustworthy, and what to look at instead so you can actually run your trade business with real numbers. Here's the thing about a profit and loss statement. It's a snapshot of revenue and expenses over a period of time. Simple enough, but the way most trade contractors have their books set up, that snapshot gets distorted in two specific ways during busy season. The first distortion is timing. When you collect a deposit on a job, depending on how your books are kept, that deposit might be hitting your revenue line right away, even though you haven't done the work yet. On the flip side, the materials and labor for that job might not hit your expense line until weeks later when invoices come in or payroll runs. So what happens? Revenue shows up early, expenses show up late, and for a month or two, usually May, June, or July, your profit and loss looks like a rocket ship. It's not a rocket ship, it's a timing mismatch. The second distortion is job costing, or the lack of it. Most trade contractors I meet have their profit and loss set up with one big bucket called materials and one big bucket called labor. That tells you what you spent in total, but it tells you absolutely nothing about which jobs made money and which ones didn't. You can have a P&L showing 35% gross margin, and 3 out of your last 5 jobs maybe lost money. The winners are carrying the losers and you don't even know it. So if the P&L isn't telling you the truth, what should you be looking at? First, and this is the universal upgrade for every trade contractor, job level profitability. Every completed job should have its own profit and loss. Revenue from that job, materials for that job, direct labor for that job, subs for that job, and the gross profit that's left. When you can sort your jobs from most profitable to least profitable, you can finally answer questions like, which customers are actually worth chasing? Which crews are most efficient? Which type of work should I be bidding more of? This is the single biggest upgrade most trade contractors can make. It doesn't matter if you're roofing, HVAC, electrical, plumbing, concrete. Without job level data, every decision you make is a guess. With it, you actually run a business instead of just running jobs. Second, gross profit margin trended over time. Not just this month, looking at your gross margin month by month, quarter by quarter gives you the early warning signal. If your margin is drifting down even 0.5% a month during busy season, that's a real problem you need to catch in May, not in December. Trended margin is what lets you spot the slow leaks. The bid that's a little too low, the supplier whose prices crept up, the crew that's working a little slower than they used to. Those things don't show up in a single month P&L. They show up in a 12-month trend line. Third, and this one is for only a specific group of trade contractors, and that's work in progress or WIP accounting. WIP isn't for everyone in this industry. If you're running short duration jobs, residential roofs in a day, service calls in an afternoon, small installs in under a week, WIP probably adds more complexity than insight. Job costing is your priority, not WIP. But if you're running longer duration projects, commercial work, big residential remodels, jobs that span weeks or months with progress billing, WIP changes the game. Instead of recognizing revenue when cash hits the account, WIP recognizes revenue as you actually complete the work. If you're 60% done with a job, you've earned 60% of the revenue, not the 80% you've collected in deposits, and not 0 just because you haven't billed the final invoice. WIP is also what banks and bonding companies want to see if you're trying to grow into bigger projects. So if commercial or bonded work is on your radar, WIP is non-negotiable. The point is, pick the upgrade that fits your business. Job costing for everyone, trended margin for everyone, WIP when your job durations and your growth ambitions call for it. Let me give you a real-world example of how this plays out. I worked with a trade contractor last year who came to me in late summer feeling great. His profit and loss showed almost double the net income from the prior year. He was ready to buy a second truck, hire 2 more guys, and put a down payment on a shop. We rebuilt his books with proper job costing. The picture changed completely. Once we could see margins job by job, and overall, the story was clear. His storm work had been crushing it, but his recurring service work had quietly collapsed because his labor costs had gone up and he hadn't repriced. He didn't buy the truck, he didn't hire the 2 guys. He repriced his service work and renegotiated with one of his material suppliers. By year end, he was actually profitable and he kept his cash. If he'd trusted the original P&L, he'd have been underwater by February. That's the difference real financial information makes. This week, ask your bookkeeper these 3 questions. 1, can you pull me a job profitability report for my last 10 completed jobs? 2, what has my gross profit margin been month by month for the last 12 months? 3, if we run longer jobs, are we set up to track work in progress? And if not, should we be? If your bookkeeper can't answer these questions, or the answers don't make sense, your financials aren't set up to actually run your business. They're set up to file a tax return. And there's a big difference there. Book a call and see how we can shore up your cash flow. While you're on the job site, we're on the books, making sure the numbers measure up. Have a great day.